The market is currently closed. The last available data for Tilray Brands Inc., TLRI, shows a closing price of 1.19 on Friday, September 5, 2025. This closing figure, up from its lows but still a fraction of its former glory, is a testament to the persistent speculative cycle that defines this stock. While a single-day rally or a jump over the past few weeks might create the expectation of a sustained turnaround, the reality is far more complex and sobering. This is not a company whose price is driven by incremental improvements in its core business. It is a highly volatile vehicle for trading on the promise of USC. Federal cannabis reform, a promise that has repeatedly been dangled and then withdrawn. The fundamental business of Tilray, a multifaceted enterprise with ventures in cannabis, beverages, and wellness, is consistently overshadowed by a single, seismic event that may or may not ever happen on a timeline that matters to investors. This perpetual tension between the what-if of political change and the what-is of a struggling business model is the core psychological struggle of every investor who holds or considers holding Tilray. The recent price action of Tilray, particularly its run-up from a 52-week low of 0.35 to its current trading range, is a direct result of this speculative frenzy. The chatter around a potential Schedule III reclassification of cannabis in the United States has once again put the entire sector, and Tilray in particular, in the spotlight. Retail traders, hungry for a quick profit, are piling into the stock, driving up trading volume and creating a false sense of momentum. The most recent earnings report, which showed the company's GAAP net loss widening significantly despite a revenue beat, is a perfect example of this disconnect. The market chose to ignore the massive non-cash impairment charges and focus solely on the top-line growth and the positive commentary around a path to profitability. This is a classic case of selective perception, where investors filter out the bad news to reinforce their existing bullish bias. The high volatility, as evidenced by its dramatic swings, is not a sign of a healthy, functioning market. It is the fingerprint of a high-risk, high-reward bet. The stock's Relative Strength Index, RSI, while currently neutral, is a loaded metric, poised to either shoot into overbought territory on the next positive rumor or plummet on any negative news. Institutional investors as a whole remain cautious. While some funds hold Tilray, the overall consensus among professional analysts is a hold, with a wide range of price targets that reflect the sheer uncertainty of the business. The wide gap between the low and high price targets is a clear signal that even the experts are struggling to assign a firm value to the company. Beyond the daily price swings and regulatory headlines, the fundamental business of Tilray is a fascinating and often misunderstood story. Tilray is not a one-trick pony. It is a sprawling consumer products company. It has operations in medical and recreational cannabis, but its strategic acquisitions have made it a major player in the craft beverage industry, with brands like Sweetwater Brewing Company and Breckenridge Distillery. The company's distribution and wellness segments further diversify its revenue streams. The expectation from management and many long-term investors is that this diversification will provide a stable foundation, allowing the company to weather the storms of the cannabis market and eventually become profitable. But what is the reality? The most recent financial reports show that while the beverage and distribution segments are indeed contributing revenue, they haven't been enough to offset the company's overall losses. The cannabis market, especially in Canada, is plagued by oversupply and intense price competition. The company's Canadian cannabis market share, while respectable, has been a difficult and low-margin business. The dream of a diversified, profitable consumer products powerhouse is still a distant reality. The company's continued struggle with profitability, as reflected in its substantial net losses, is the harsh truth that stands in stark contrast to the optimistic narrative pushed by some investors. The high debt burden from past acquisitions also remains a concern, making its path to financial stability a difficult climb. The most recent fiscal year saw a substantial net loss, primarily driven by goodwill and intangible asset impairment charges. This indicates that the company is still paying the price for past strategic moves that have not yet delivered the expected value. The future outlook for Tilray is entirely dependent on its ability to bridge the gap between expectation and reality. The bull case hinges on a number of catalysts, primarily U.S. federal cannabis reform. A full-scale legalization or a reclassification to Schedule III would open up a massive new market for Tilray, potentially allowing it to leverage its existing infrastructure and brands. The company has already positioned itself to be ready for this by holding a portion of its assets in a US-based entity that could be activated upon a favorable change in law. Additionally, continued growth in its European medical cannabis and beverage segments could eventually lead to profitability. This is the promised land. However, the bear case is equally compelling. The political process is slow and fraught with uncertainty. Legalization may be delayed or may not happen at all under the current administration. Even with a policy change, the new market would be highly competitive, with established U.S. operators already holding a dominant position. Tilray's high debt load and persistent losses could continue to be a drag on its financial performance, and its diversification strategy might not be enough to save it. The company's recent move to reduce its debt is a positive step, but it is not a silver bullet. The market's current valuation of Tilray is a clear reflection of this binary outlook. It's a bet on the future, not a reflection of present-day performance. It is a high-risk gamble, and investors must be prepared for extreme volatility based on the daily news cycle, not on the quarterly earnings. How many shares of Tilray do you currently hold? And what's your ultimate price target for the stock? Comment below. In conclusion, the story of Tilray stock is a powerful narrative of unfulfilled expectations and a very challenging reality. The expectation is that this company is a sleeping giant, ready to be awakened by a single political decision that will usher in a new era of profitability. The reality is that Tilray is a struggling, unprofitable company with a complex business model and a history of significant losses. While its diversification into beverages and wellness offers a glimmer of hope, it has not yet proven to be the financial lifeline it needs. The stock's price is a direct function of hope and speculation, not of fundamental business strength. Until the company can demonstrate a clear and sustainable path to profitability, independent of external political catalysts, it will remain a high-risk, high-reward investment defined by extreme volatility and the constant, punishing contrast between a glorious future and a challenging present.